welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think we have to focus also on the fact that there were some significant downward revisions. That puts the labor market on a lower trajectory when it comes to job growth. And even though the unemployment rate did not rise, we saw a pullback in labor force participation. That tells me that labor supply is under pressure from induced immigration. That's going to be another factor that we have to pay close attention to.
I don't think this is a kumbaya situation between these two men. I think this is going to be a permanent rift. I think they've gone nuclear with each other and gone after each other in such a way and so publicly. I don't see that as a realistic option. I do see both sides surviving well. Musk is sort of the Da Vinci of our times, and he's complicated. But when you have that, this is not going to end in a way that's nice for either one of them. Both equities of the U.S. government and Donald Trump will be fine. And Tesla will be fine. I agree with Craig in that, but they're not going to high five.
The good thing about Broadcom's software exposure is that it does give it stability. Yes, the mainframe market isn't growing, VMware's market isn't growing, and the other software they have, not really growing at the same rate of AI, but it gives you a lovely annuity-like revenue to be able to invest in things like the chips that it is bringing to market to AI. So that, if you're a nervous AI investor, maybe Broadcom's for you.
We got 1 hour to go until the market close. Taking a look at the major averages, and as we sort of come down and relax after the busy fighting yesterday between President Trump and Elon Musk, today the focus changed, of course, to the jobs report. And there wasn't too much to get people upset. We saw the headline number, 139,000, come in higher than estimates. We saw pretty significant downward revisions, as you just heard Greg Dacco talking about, for the prior 2 months. Unemployment rate staying the same. Everything's okay, it seems like, for the moment. Stocks up. The Dow up 445 points, about 1%. The S&P 500 up 1.2%. The NASDAQ up 1.4%.
I think that sums it up very well. Nothing to upset anybody. You had 139,000 jobs added. As you noted, Julie, unemployment rate stays steady at 4.2%. It was stronger than feared. I think you saw that kind of relief. I saw economists telling their clients, they mulled over the report, and they said basically to them it was more evidence of a labor market where, as we have said, okay, I'm seeing some moderating, I'm seeing some cooling. I'm not seeing collapsing.
No.
And I think that was the takeaway.
I did see the word in more than one economist note in reaction, the word cracks. The cracks are starting to show. You saw a decrease in warehouse and transportation jobs, for example, that could be linked back to tariffs, but nothing to really cause that much consternation. Interesting here to see yields move higher. This doesn't seem to change the trajectory of the Fed, according to many economists, seeing 4.51%. And then there is day two, I guess, of the big story that we were watching yesterday. And that was, again, this big drop that we saw in shares. If you take a look at a 2-day chart of Tesla, what we saw yesterday, that huge drop, huge market cap wiped off of the value of Tesla, $152 billion. It is coming back a little bit today, as it seems like there is at least an uneasy quiet between the two men, if not, a truce, so to speak, that is sending the shares bouncing a little bit today.
And one other thread I would just quickly mention is that a short time ago, President Trump announcing on social media next round of U.S.-China trade talks in London next week. What's going to come of that, Julie? I have no idea. But I think investors at least maybe think, okay, high level, at least they're engaging, at least they're talking.
Yes, right? I will say, there wasn't any really reaction to that headline, particularly in stocks that we could see. Maybe that's because it's not a big surprise. Maybe that's because it's a summer Friday and nobody's around. I don't know.
That would be another good reason.
Yeah, but there wasn't a big reaction.
Well, for more on the Trump versus Musk fallout, let's welcome in here Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research. Dan, it is always great to see you. So Trump and Musk, Dan, The bromance, the breakup. You look at Tesla stock, as Julie was just pointing out. It's moving higher today, but it got whacked yesterday, Dan. And I want to ask you, when you saw that reaction in the stock, what did you think, Dan? Did you think that move was justified? Did you think it was an overreaction? What were you telling clients?
I mean, look, Josh, I thought it was a shock, almost Rod Serling, Twilight Zone sort of, that Musk and Trump went from BFFs to this frenemy situation, right? It's almost like a junior high sort of fight that's happened between these friends. And I think it caught investors off guard because you knew Musk was pulling away, but you didn't think that this was actually going to start really a battle where a friend could become an enemy. And that's a cascade effect because investors were worried if Trump becomes an enemy, not a supporter in terms of the autonomous roadmap. I think that was an overreaction, but that's why investors were fearing it.
Well, and Dan, does it also remind investors of what looks from some angles, maybe from many angles, like Musk's instability, right? We of course recently had that story in the New York Times that said his drug use during the campaign was more extensive than had been understood before. Then you see this sort of lashing out against the president. I mean, do you think that there is really solid investor confidence in his leadership?
Yeah, and Julie, look, I mean, to me, Musk is not going to be someone that's drinking tea and doing a cartoon puzzle at night. So I think investors, they understand who Musk is, whether you love him or hate him. So I think they're able to kind of see through that in terms of some of these controversies. Now, in terms of here with Musk, look, at the end of the day, no one wants Trump as an enemy to Musk. You want him as a friend. And that's why I think behind the scenes right now, there's a calm, right? I think maybe, hopefully cooler heads prevail, intermediaries, because at the end of the day, Musk needs Trump, Trump needs Musk.
I don't know. I mean, I think tea and a cartoon puzzle sounds lovely to me, Dan. But
Josh, especially wearing a sports jacket, like a bullish sports jacket like that, you could pull that off.
Absolutely.
But not Musk.
No one doubts that. Let me ask you.
Wait a minute. Wearing a shirt like that, Dan. What does that tell us then about your consumption habits? I don't know.
That's not tea and cartoon puzzle. That's a whole nother. That's a whole different vibe. Let me ask you, Dan. Did you think, though, in all seriousness, that this drama, does it overshadow in any way, Dan, some of the reasons I think you can argue you saw this move in the stock off those April lows, specifically Musk's return to Tesla and the robo-taxi event next week?
Yeah, Jack, look, if you think this is going to get worse and worse, and then Trump ultimately puts blockades in, the state doesn't go to federal, the autonomous roadmap doesn't happen, that's our whole view. That's how you're going to have cybercap 25 or 30 cities over the next year. Okay, then it's a negative view. But my view here is that this is basically a frenemy junior high school battle that's happening here. I don't view it as a long term. I still believe they're allies, and it doesn't change my view that the regulatory roadmap is going to be more green lighted for Tesla and the autonomous. It could also help Waymo and others. But that's where I think we're going. And that's sort of my view. I don't think that this is the beginning of a dark storm between Musk and Trump.
By the same token, it does seem like the EV tax credits are going to be in the tax bill. That is something, just if you talk in pure dollars and cents, is going to take away from the company's earnings this year, right? So, I mean, are you baking that in as the base case to your models at this point?
Yeah, and Julie, coming into the year, we thought that. I mean, I think they were, and my view is always, it will hurt Tesla, but hurt Tesla less than competitors. So ultimately, they do actually, to some extent, given their scale and scope, they could be profitable selling $35,000 cars. You can't say the same for those in Detroit in terms of big three. Now, do they want it? They don't. I mean, Musk doesn't want the 7,500 credit to go away. But I do also believe now that he's out of the White House, he has to play a game of politics here too. Because there's a broader game going on. As he distances himself from Trump, that makes him more positive in Beijing. and China is very, very important to Tesla, raw materials, production, demand.
Well,
So there's a lot of sort of 4D, chess going on too.
I don't know. I'm always suspicious of the 4D chess comparison when it comes to people in Washington. But I do want to pick up on the China angle that you mentioned, Dan, because there was a report out of Reuters today that China had given sort of temporary licenses for rare earth mineral export to the main automakers, but not to Tesla. According to that report, it was Ford, GM, Stellantis that got it, but Tesla did not. Is that something that's going to disadvantage them?
Yeah, I think the devil's in the details. I do believe, given what we see with Tesla in Shanghai, given their production footprint, I think they'll have that same access. I'm not sure if it's from a timing perspective, but Tesla actually has an advantage when it comes to because they're so cemented in China. And I think when it comes to for Musk, look, this is like a road to recovery. I mean, post Doge, post a dark chapter, I think he's made great moves. Obviously, next week's a huge move in terms of autonomous and the Tesla, in Austin and that sort of ramp. But in terms of what we see with Musk and Trump, it's two kids in the sandbox, and a little bad. But eventually, I think the play date's back on.
Dan, I want to switch gears, talk about another name you covered. That would be Apple. Their big software show starts on Monday. I believe you will be there, Dan.
Yep.
I think it's fair to say expectations tempered on this one, Dan, but what do you expect to hear as an analyst who remains, I know, firmly bullish on this name?
Yeah. And Josh, you've been in so many of those over the years. I mean, my view is low bar, but at the end of the day, the developers are the hearts and lungs of Apple and the Cupertino ecosystem. I think right now sentiment is way too negative on Apple. The consumer AI revolution, it's our view, like that goes through Cupertino. And I think as you look at this next iOS update, it all sort of sets up for what's going to be the big Apple intelligence in 2026, the early part. And I think this is going to be the upgrade cycle. It's late to the game, but with an install base of 2.4 billion iOS devices, 1.5 billion iPhones, you could be late, and that continues to be our view of Apple.
Dan, great to see you. Have a fantastic weekend.
You too.
I don't know. I'm going to go around and look at what people are wearing and make some, I don't know, maybe I'm going to make some theories now.
Make some quiet judgments.
Yeah. Of course. It's a Friday. Why not?
Why not? All right. Thanks a lot, Dan. Well, stocks higher today to close out the week with the S&P 500 topping the 6,000 level for the first time since February. With more on the latest market moves and what it means for your portfolio, let's welcome in Mark Lucchini, Chief Investment Strategist at Janney Montgomery Scott, which has over $153 billion worth of client assets under management. Mark, it is great to see you as always. So you look at this move upwards today. Yes, we had a jobs report that beat estimates by a little bit. You had that downward revision. Overall, are you surprised by the move today? Do you think it's justified in the data that we got?
Well, I do. I think it was a number that's really in the sweet spot. You're talking about average job gains over the last 3 months of 135,000. Given the fact that the labor force participation rate is kind of stalled out and flatlining both for overall labor as well as those prime age 25 to 54, it suggests that the number of jobs that need to be created on a monthly basis is probably slowing and well below 100,000 at this point, which is likely going to be able to be exceeded in terms of the job gains as we look forward, and therefore are able to maintain the unemployment rate around where it stands today at 4.2%, which isn't quite the lowest since 1969 in the mid threes that we saw some time ago. But then again, on a historical basis, still very low and indicative of a labor market that is in pretty good shape.
Mark, what do you think the Fed made of that report?
Well, I think once again, it gives them every reason to be, keep their options open. I think that they're still leaning towards a rate cut, certainly, than necessarily a rate hike. But having said that, it just demonstrates that there's no urgency for them to have to react in an upcoming meeting, for instance, this month. We see the betting markets, of course, in the market have priced in odds of about 1.8 cuts between now and year end, with about a 70% chance of one occurring in September. I think that's reasonable. We'll see if inflation continues to cooperate, and if it does, they will have a green light. Or conversely, and hopefully not the case, you see some fissures starting to emerge in the labor market that suggest perhaps it's about to give way, and as a consequence of that, the Fed must stand and act in order to support their maximum employment mandate.
I was watching the bond market today and seeing those 10-year yields go above 4.5% again. We weren't seeing a commensurate move in the 30-year necessarily, but levels like that, is that going to be problematic for stocks or not when it's accompanied by okay economic data?
Like Julie, I think it's more the latter. As long as it's accompanied by data that suggests that it's not serving as friction to the economy and the kind of necessary corporate profitability that at the end of the day is what supports stock prices, I think we're fine. However, it really works against the equity market if it does one of two things. One, the spike in interest rates comes in a meaningful fashion, meaning quickly and by order of magnitude. And or secondly, we grind higher, but nonetheless, we move up and toward the upper end of the range that we've been in here for quite some time, which is around 4.75% to 4.8%. That's the point at which yields give the equity market a nosebleed. And we've seen some pressure come into the tape when we've seen yields back up to those levels, which begin to threaten concerns, of course, about multiples for the stock market, particularly when equities have moved up, really in the absence of a commensurate lift in earnings, at least quite at the same pace, putting the market at about 22.5 times forward earnings. This is where we were in the beginning of the year, where the market got a little heartburn when it got less than good news as things evolved, both in terms of the economic news as well as on the administration relative to tariff policy.
Mark, it's interesting. We obviously had this big move off April lows. It feels like a market that wants to keep grinding higher. In the near term, Mark, what would you flag as potential catalysts for the market? We do have some big tech events, Apple and Tesla coming up. We got some inflation prints, but curious what would be on your radar.
Well, I think certainly if what I mentioned before, what would put pressure on the tape, of course, is yields moving higher in the absence of data that warrants it. Secondly, I think it's just more of an accumulation of data that is showing that the hard data isn't collapsing down to the soft data. Much has been made of the fact that consumer and really business sentiment alike has been quite poor. And worries, of course, is that the hard data was ultimately going to give way to match that sentiment. And so far, at least today is an exclamation point on that. The hard data is hardly giving any reason to believe it's catching down. In fact, maybe the soft data will catch up, as we saw from the conference board report earlier in the week. And so that would be one thing I would be looking for. The other, of course, obviously, the overarching narrative remains tariffs. And so anything that would provide some level of certainty, whether it's coming down to a level that is likely to stabilize at, even if it's well above where we were pre-Liberation Day, or obviously the announcement of some deals that begin to emerge with trading partners that would be important to suggest that progress is being made towards satisfying and resolving these trade spats and tensions in a way that there creates more visibility for companies to make forward-looking statements and expend capital on business equipment and hiring. Those are the kinds of things that the market will really bid on. But I'm afraid we're in a period that's kind of a vacuum for news on that front, obviously leading up to July 9th when that 90-day window expires. So hopefully we'll get some announcements on that front sooner rather than later. And to me, that would really catalyze why this market would probably take a pretty decent leg up.
Yeah, we'll see if that ends up happening. Mark, have a great weekend.
Thank you very much. You the same.
Coming up, Apple's annual Worldwide Developers Conference kicks off on Monday. We'll preview that event on the other side and tell you everything you need to watch from the tech giant. Stick around, more market domination still to come. It's time for our trending tickers. We're watching DocuSign on the decline, Manchester United kicking higher, and Petco is sinking. Let's start with DocuSign. It's seeing some of the lowest share prices in over a month. The company's first quarter beating estimated revenue but missing billings expectations, and the company also adjusting its full-year billings outlook, signaling potential stalling for its growth. So the shares, as you can see, are tumbling there. And, really it was that billings forecast that accounts for the declines here. DocuSign has been such an interesting story because obviously this was a pandemic sort of really sea change in the way that we signed documents. But since then, the normalization happened, and then it just hasn't seen that recovery. I mean, I was looking back to 2021, the high in the stock, 310.05 was the high, and it's trading, around 75, 76 now. So it's just been bumping along at this level for a very long time.
Yeah, so what do bulls say on a day like this when the stock is just getting wrecked here? Team at Jefferies, led by Brent Till, friend of the show. Brent is sticking with this one. Told his clients he would consider that reaction overdone. He still sees this one, in his words, as a top mid-cap value play. He argues the Q1 jitters will pass. Product stories broadening out. No change, he says, to leading core signature business. Maintains the buy.
He is in the minority, though, right? Yeah. Because there are 5 buys on this one, 15 holds, and 1 sell.
Yeah, target 105 for Brent. All right, Manchester United shares are up after reporting third quarter earnings despite missing revenue estimates. The football club sharing some rallying news and adjusting their forecast for the remainder of the year. This one, stock jumping. Football club boosts its adjusted EBITDA guidance for the year. I do see some analyst side is saying, and this is the team also at Jefferies, saying the company raised the sales outlook, increased the adjusted EBITDA guidance, reflects the impact of ongoing cost-cutting efforts. They have a buy, target is 26.
Man United has had a rough year.
Yeah, rough.
And
yeah,
so this coming, it's down hard because they haven't been playing well. Yeah. And so, it's funny because obviously we don't have really a lot of publicly traded access to sporting teams here in the US, but in Europe, the fate of the stocks is frequently tied to whether they're winning or losing, because the thinking being, I guess, if they're losing, not as many people are going to be spending money on the club. And Man United had a bad season. It lost the Europa League final against Tottenham. And that was back in late May, and we saw the stock really drop on that. So this, a relief for investors. It looks like that they're cutting costs and trying to mitigate some of the losses they've seen.
In the street, there's not a ton of coverage, and they're split anyway, 2 buys, 2 holds.
Yeah. All right, let's talk about Petco Health seeing losses today following the announcement of its first quarter earnings. Sales for the company down 2.3% this quarter. Comparable sales fell 1.3%. The pet supply retailer says that tariff uncertainties are a primary cause, in addition to growth initiatives which aren't expecting results until late 2025 here. So I feel like, Wolf is the ticker on this. And I feel like we always make sort of the Wolf joke because they've had some disappointing quarters as of late. This is not the first that we have seen here for Petco, unfortunately for them.
Citi neutral on this one. I see them cited as saying they see the results as actually encouraging. They argued the weakness was overblown. Changes they told their clients are happening in stores which could potentially drive a return to sales growth in the second half. Tariffs they emphasize are being mitigated. Stock is down pretty hard this year, about 25%. Most analysts like Citi are on the sidelines.
You're a pet owner. I know we've talked about this before. Are you a Petco customer?
I am not. I'm not a Petco guy.
I go in there occasionally, but usually, I think a lot of pet owners, order their stuff online now.
And Citi says, to your point, the cat category reset in May and the dog category reset last week. In case you're wondering. For those of us with dogs and cats.
Yes.
Big news there.
I'm just a dog household in my case.
Nothing wrong with that.
No.
Nothing wrong. Apple is kicking off its Worldwide Developers Conference on Monday. It is, of course, a pivotal moment for Apple as it competes in the AI race. For more, we're bringing in now Yahoo Finance tech editor Dan Howley. I got to say, Dan, expectations in this one tempered.
Yeah, kind of mid, as the kids say, when it comes to the expectations for this particular WWDC. This is, of course, their annual developers conference where they roll out new versions of iOS, Mac OS. Sometimes you get a hardware update here and there, but really what everybody's going to be talking about is what the AI outlook is for Apple. And, last year they had announced their Apple Intelligence platform. That's kind of hit with, I think the big deal for them is, whether or not they're able to push the narrative forward when it comes to AI. So they have to prove that they can compete in the AI race. It's something that they haven't been able to do yet. Everybody on Wall Street is kind of waiting on tenterhooks to find out when they'll announce something big, or when there'll be a product that people get excited about. They also need to show a clear path forward for Siri. Siri has been delayed. It was supposed to be out already, but they have put it kind of on the back burner for a minute while they let it cook a little longer. This is a platform where you're supposed to be able to use kind of agentic AI capabilities. It's, the example that they laid out last year was, your mom's coming in on a flight. You ask Siri, when should I leave? It'll then go into your email or messages, find out what time the flight was, then check real-time flight data and give you the information on when the flight will land. So that's kind of the agentic AI approach to that. And then really, they have to show that their AI is worth something for developers. The developers are the ones that are going to build out the AI functionality for them. And so if they're able to show that, look, we're opening this up, which Bloomberg's Mark Gurman said they'll open up their smaller AI models. If they can open those up and allow developers to build on them, that could be huge. And I kind of equate it to the idea of having the App Store originally. Obviously it set off huge economic change. I'm not saying that that's going to be the same result, but what I am saying is that, it just shows what developers can do when they get their hands on a product. And so that could be a boon for them if they manage to do that.
Do you think, knowing that, Dan, knowing that this conference, listen, it's geared for those millions and millions of developers all around the world, and Apple execs, their job is to get up there and explain to these developers, hey, you all want to keep building killer apps and experiences for our ecosystem. I mean, if you were in that audience, Dan, and you were a developer, what would you need to hear?
Well, I think for a lot of developers they're just big fans, right? So, they'll see, Craig Federighi or Tim Cook and lose their minds. But I think for the ones that really want to know what's going on, it would be that they're continuing to build out their AI stance, right? We just saw Microsoft's conference. We just saw Google's conference. They rolled out tons of AI functionalities, right? Google announced its new AI mode is available. That's basically like a Chat GPT kind of rival, but in Google search. So these are big changes that these companies are making. Apple hasn't been able to do that yet, and it hasn't really shown us anything. There were commercials originally explaining how Apple Intelligence would work. Those have gone by the wayside because that functionality is just not out there yet. So I think giving the developers an idea or a timeline maybe of when these capabilities will finally be out would behoove Google and give these developers something to look forward to and get them more excited to build.
Separately, on another note, President Trump is planning to extend the TikTok deadline again. At least that's according to reports. So what can you tell us about that?
Yeah, TikTok was supposed to go dark, or something was supposed to happen. We don't really know later this month. The original deadline was back in April, and that was extended, and now the June deadline is coming up. And this is according to the New York Post. They're going to extend it again, or President Trump could extend it again. There's been talk back and forth about deals going on between U.S. companies and trying to maybe tie this up with a trade deal with China, figure out how to get TikTok to be a U.S. company or not owned primarily by a Chinese entity. There's been talk about different companies getting in there. Oracle, Walmart was floated around for a while. It really doesn't seem like there's any, outside movement to the outside world. There doesn't seem to be any movement. Obviously, these are all negotiations behind closed doors. But I think, at this point, Trump has shown that he supports TikTok. He likes TikTok. He's, kind of credits it with helping him win over younger voters. I don't think he's going to let it go away. At this point, though, it's just how far can you kick this can down the road before something happens?
Dan, thank you. Appreciate it. Coming up, the May jobs report showed the U.S. labor market remained largely resilient amid President Trump's new tariff policy. We're joined by an economist to break down the numbers on the other side. Stick around. Much more market domination still to come. The U.S. job market keeps on holding up. 139,000 jobs added in May, beating expectations and extending a steady streak despite inflation and policy headwinds. For more, we're bringing in now Jennifer Lee, senior economist and managing director at BMO Capital Markets. Jennifer, it's good to see you. So on that jobs report, Jennifer, I saw some economists today. They read through the report, Jennifer, and they kind of characterized it to their clients as this. They said, to them, more evidence of a labor market that, okay, it's cooling, but not crashing. Is that how you see it?
That's a great way of putting it. And thank you very much, by the way, for having me on. My automatic reaction, the first words that came out of my mouth were, not bad, not bad. I think we were sort of thrown by, what we saw from the ADP with that very low figure. So I think everyone was quite nervous. The market was quite nervous, but again, 139,000, steady jobless rate of 4.2%, gains throughout other different sectors like construction, leisure and hospitality, education and healthcare, for example. So we're seeing still steady gains in various sectors. Other sectors are cutting back, obviously, but overall, not a bad report. I'm going to say that the one thing that I thought was actually the most positive news out of that was the average hourly earnings report of 0.4%, or the increase of 0.4% above expectations, the highest in a few months. And it's good news for the average worker. At least they have a little something, a little extra money in their pocket for when they're ready to spend. Not great news for employers because that means that they're shelling out a little bit more for wages and salaries. But at the same time, I think it's good support for the U.S. consumer, which is, the biggest, underpinning, I guess, for the overall U.S. economy.
What does that number imply, if anything, Jen, for inflation more broadly, right? Does that piece tend to be sort of a leading or lagging indicator for bigger inflation numbers that we know the Fed is watching really closely?
Yeah, so can we sort of debate that around here as well? Typically when you have higher earnings, or wages, it tends to be inflationary. But I think that's under the, the normal assumption that people are going to take their money and start spending like crazy. But I don't think that's happening. We certainly haven't been seeing that organically, I guess is the word that I'm looking for right now. Everyone, as long as you have the money, and I think people, of course, were spending earlier in the year, just in advance of all the feared tariffs, the feared inflation, higher prices for all these goods. There was fear of empty shelves ahead of the holidays, for example, which is just 6 months away. So there's a lot of, again, pulled forward spending. But I don't think in this case it's going to be too inflationary from the consumer's perspective, because I think they're just going to put aside a little bit for a rainy day. We saw that in the April personal spending and income report, where they pushed up the saving rate a little bit. And that's not a bad thing. As long as they're in a position to spend when they want to spend, I think that is the most positive aspect of all of this.
Jennifer, what do you think Jay Powell and the Fed made of this jobs report today?
I feel very sorry for the Fed chair. No matter what, I think he's in a very tough spot. Great news that the U.S. economy is still growing. Great news that the job market is still churning out jobs at a steady-ish, albeit slowing rate. But yet, there's that pressure from the Oval Office to cut. From calling him now too late Powell or something like that. Which, anyway, I think it puts him in a very tough spot. But I think all of the Fed members of the governing council, I believe that they're all on the same page, saying that they are going to be patient. The minutes from that last meeting stated that felt that they were well positioned to wait and to be patient, and that seems to be sort of like the theme that we're seeing playing out. Like the ECB yesterday cut rates 25 basis points, and it sounded a little bit less dovish. With Christine Lagarde saying we are in a good place. Everything that we've done so far with the rates the way they are right now, I think we're in a good place to sort of take whatever is going to be coming toward us.
So as you look forward, do you think the balance of risks are skewing more negative or positive? And I want to ask specifically through the prism of revisions, because I definitely saw a few of your colleagues, other economists today, saying, they were looking at those revisions, which were pretty negative, and also saying this number that we got today is likely going to be revised lower.
That's interesting. So usually it seems like the trend now has been for backward revisions that were going down.
Right.
So you're sort of expecting that. And again, the number isn't, 139,000 wasn't anything to write home about, but at the same time, it wasn't a negative. It wasn't as if people or businesses were cutting jobs. It's not like 250. I remember at one point a couple of years ago, it was on 500,000. So, we're not at that point yet. So the revisions, yes, they will come. There's also some question about, the quality of the data, whether or not everyone is filling it out properly, enough people are filling it out. So there's still a lot of that, but I think it all depends on all the different job surveys that you're looking out there, not just the non-farm payroll survey, looking at surveys like from the Conference Board, from the ISM, seeing what businesses are saying about hiring, whether or not they're hiring or laying people off or whatever, or attrition. As long as it's all pointing in the same direction, I think we can have a pretty comfortable view of how the labor market is faring.
Jennifer, final question. I did want your take on Trump's budget bill, the big, beautiful bill, Jennifer, as he likes to call it. Obviously, concerns being raised about what that means for debts and deficits. I'm curious how you're thinking through that bill, that legislation, Jennifer, as an economist.
So it's going to be a lot tougher, obviously, to push through the bill as it stands right now through the Senate. And we've got a deadline of July 4th, especially on the heels of the Moody's downgrade. Again, not a shock, but just the timing of it was tough. And you're going to see a lot more pushback, I think, because there's a lot more concern about spending too much, not cutting the deficit enough. So there's going to be something's going to have to be taken off the table. Unfortunately, it might look like it's going to be some of the things that he campaigned on, like such as taxes on overtime, for example, or chips. So something like that. Although he'll probably be fighting tooth and nail for those again, because that's what he campaigned on, and that's what people were voting on. So I think it's going to be a very different picture from what we saw pass through the House, whatever we're going to see pass through the Senate. But foreign investors are going to be watching this, and you're also worried about how bond markets are going to be reacting if you're going to see a big backup at the long end. And that could be problematic for the entire economy because that impacts consumer spending, mortgages, auto loans, and so on and so forth.
Yeah, and we've seen little glimmers of that. We'll see how it plays out. Jennifer, thank you so much. Have a great weekend.
You too.
Coming up, we're breaking down the best ways to be positioned among pharma stocks with our investor playbook. Stick around, more market domination still to come. From policy and regulatory uncertainties to tough competitor dynamics, the healthcare space is facing a difficult backdrop right now. As the global healthcare landscape navigates uncertainty, we're looking at how to play the dynamic environment in the Yahoo Finance playbook. Joining us now, Saad Haider, Goldman Sachs Global Investment Research lead U.S. pharmaceutical analyst and head of the healthcare business unit. And Assad is also preparing for Goldman Sachs' healthcare conference, where he's going to have a chance to talk to a lot of the CEOs within his coverage. So should be interesting to hear what they have to say, Assad. But I know in advance of that, you're kind of looking at two main treatment areas as where the most excitement, I guess, and development is right now. One of them is GLP-1s, which, goodness, we have talked a lot about. But the other has to do with oncology. Talk to me a little bit more about that right now, the backdrop there, because it's gotten relatively less attention.
Yeah, great question, and thanks for having me, Julie, again on this. Yes, we head down to our healthcare conference next week. Like you said, we've got about 200 companies from across the healthcare ecosystem converging in Miami, where we're going to be looking for direction and color on things like policy uncertainty, et cetera. But I think from a bottoms-up perspective, our focus really is on fundamentals and on new product cycles. And like you said, GLP-1s and obesity is one that's been talked about ad nauseum, although that's one that we're still very excited about. But there is this new emerging modality to treat cancer. It's called, it's basically combining two tried and tested mechanisms for cancers. One's called VEGFs, one's called PD-1s, and combining them together. And basically the thesis is that the sum of the parts is really greater than the whole. And you've seen some pretty promising early data from some companies on these modalities. And there's been a lot of partnerships that have been evolving from global pharma companies. The most recent one of which you saw this week earlier, where Bristol Myers partnered with a company called BioNTech to collaborate on developing these PD-1 VEGF bispecifics. And right before that, about 3 weeks ago, you saw Pfizer jump into the fray with another Chinese company called 3S Bio with a deal where they want to collaborate on PD-1 VEGF bispecifics as well. And before that, Merck jumped in. And so everyone's trying to get a slice of this pie. And it's very early data, but the early data so far do look promising. And if the data hold up in later stage trials as they mature, then this could potentially disrupt the standard of care in oncology. And so, right now the biggest oncology drug is Merck's Keytruda. That is on track to do about $28 billion, $30 billion. And so there's obviously a lot of excitement on new modalities that could potentially disrupt this. And so I think that there's a lot of interest in this. We just came back from the ASCO meeting in Chicago, and this really was the star of the show that everyone was talking about.
On that GLP-1 theme, Assad, a question. What is our line of sight right now about when the pill becomes available? And when it does, what do we think? How do we think the price is going to compare to the shot?
Yeah, it's a great question. So on the availability of the pills, so Eli Lilly is actually the front runner here, and they are going to have data later this year at some point in the fall for their oral obesity pill, which is called orforglipron, and that trial is going to read out later this year. And we expect that they will file, assuming that the results of that trial do look good. We assume they will file shortly after and then have a pretty quick global launch starting in 2026 in the US and then globally right after that. As it relates to pricing, they haven't really said, given us their strategy yet. It is a good question broadly, just in the context of all the focus on pricing dynamics and international reference pricing, et cetera. I think the baseline assumption should be that it probably will get priced at some kind of a discount, certainly in international markets, and then there'll be a volume offset, and that's how we're modeling it. But it remains to be seen where these companies price the pill.
That set aside, you do have a buy rating on Eli Lilly. So given the pricing dynamics, is it just sort of a volume game at this point?
So, there's our buy rating is really predicated on the fact that they are and will remain in the pole position in a GLP-1 obesity market that is set to triple in size between now and the end of the decade. And just to put some numbers around that, the current marketed GLP-1s from Novo and Eli Lilly, the branded GLP-1s, are doing about $30 billion. That's the size of the market today. And we have that growing to about $95 billion by the end of the decade. Lilly's market share of that $30 billion today is about north of 50%, and we have that staying at just under 50% as that market grows. And so that's really the premise for our buy rating on Lilly. And in our global anti-obesity model, we do actually assume a pretty significant degree of price erosion in the high single digits. And so we are being quite conservative in the way we're modeling pricing. And you're right, the offset of that is going to be global launches and global volume tailwinds.
There's one other stock I want to ask you about, and that is Pfizer. Obviously not really playing in the GLP game, but in the other theme that you're looking at, that oncology theme, how are you valuing Pfizer? And I know you have a neutral rating there.
Yeah.
What are you looking for from that company that would make it a better proposition for investors right now?
So for Pfizer, I mean, it's basically a cost-cutting story right now, and we have to give management credit for the operational efficiency strategies that they've been taking that have been actually coming in a little bit better than I think all of us on the sell side and even investors might have been expecting. And so, from an earnings cadence perspective, there's probably some safety in Pfizer right now. But I think for a real sustained valuation re-rate, what you need to see is a revenue inflection, and it's hard to see in the context of even some of these strategies that they're taking towards these early, sort of cancer drugs that we talked about, the VEGF1 bispecifics, which they're now in the game with this company that they recently licensed this asset from. It's still early, and so for the next several years, they are going to be navigating these patent cliffs, and it's hard to see when the revenue inflects. I think what would get us potentially more positive if we start seeing evidence of revenue growth, and I think that's when the market's going to assign a higher multiple to Pfizer. Until then, it's hard to see the stock really breaking out from the range that it's been in, as you just showed.
Gotcha. Asad, thank you so much, and good luck next week. Hope it's a great conference for you.
Thank you for having me.
Well, the pharmaceutical industry has its eye on U.S.-based manufacturing. What does that mean near term for the sector? Yahoo Finance's Anjali Kamlani joins us now with more. And Anj, obviously there's been a big push in many different industries to reshore manufacturing. Pharmaceutical companies seem pretty much on board with this, but what does it look like in actuality?
Well, it actually is that they're on board, and they have been, but not for the reasons that have anything to do with tariffs. This is not something new for them. Really, the pharma industry has been pushing for reshoring since the COVID-19 pandemic, and that's because that's when they first learned of the risk of the supply chain. So what we have now is this grand big number, 270 billion plus in investment dollars that has been announced by some of the major companies in the last few months. And that is because of projects that have already been on the table or new projects that they may have pushed up the launch for announcement for in light of the Trump administration pressuring with tariffs and the threat of tariffs. The idea being that if they commit to these reshoring projects, then they will somehow get out of the tariffs. Now, that doesn't seem to be panning out. We know that the Trump administration has said that they will be announcing some sort of tariff soon, so all eyes on that. And what that means then for these companies, will they continue to commit? Will they slow down the pace of them? We're going to sit there and wait for them to tell us. But in the meantime, just take a look at the pros and cons of what this reshoring really looks like. On the pro side, you have a majority of drugs currently being produced in Europe and Asia. Europe takes the branded and Asia really for the generics. Now, US really uses a lot of generic drugs, so a lot of our reliance is on Asia for that reason. As I mentioned, COVID-19 showed us that the supply chain is at risk, and so bringing it back will help us with that. Also, newer medications, personalized medications, need to be closer to home, and that's one of the reasons why these companies were already focused on reshoring, or rather opening plants here, because there are some newer medications that have maybe shorter shelf lives or need to be closer to the patient. It's just an easier process. Meanwhile, these companies are also looking at patent cliffs, and that's something that would help boost more manufacturing, because they need to focus on their R&D pipeline, and that requires more manufacturing for dosing, for clinical trials, and the like. Now, looking at the disadvantages, costs are up at this current time, in part thanks to tariffs on some of the construction material. Also, the construction area specifically for manufacturing for pharma, they are facing labor shortages, and some of them is getting disrupted by immigration. So that's stressing the sector and means that any of these projects could hit snags and pauses. There's also the pressure from the Inflation Reduction Act and the Most Favored Nations clauses, and how much price absorption the companies will have to deal with there. Meanwhile, also the planning takes about 3 to 5 years. So if they're looking at rolling out these plans by 2030, they should really be on it right about now to make that happen. I also want to talk about some of the areas. One really interesting thing that is happening, though, with this shift and this focus is I want to take a look at this map right now, which has sort of these established hubs for pharma manufacturing. You know that the West Coast in California, as well as the East Coast, North Carolina, that Research Triangle, New York, New Jersey area, as well as Boston has been a major hub. Texas and Ohio are coming up, interestingly enough, as well as a little bit of South Carolina tied to North Carolina. And then Indianapolis, that one's interesting to me because that is all and entirely Eli Lilly, thanks to the GLP-1. So we're seeing some more interest in some different areas. So what I'm interested in seeing is how much that really appeases the Trump administration, which wants to bring back, manufacturing at large. And will it actually succeed in doing that for this industry? That's the question.
Yeah.
All right. Thank you, Anj. Appreciate it. Coming up, while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.